In his different versions of the Crash Course over the years, and also on his YouTube channel a lot lately, Dr. Chris Martenson of Peak Prosperity has been warning about exponential functions. And I'm about to show you some charts and graphs where there's a lot of exponential functions or hockey stick graphs that are now occurring either in the economy or with total people who are infected globally with the global pandemic and total deaths. So this is the linear charts of total cases and total deaths. And these are hockey sticks, as you can see. So flattening the curve is not going so well globally. There are some specific countries that have had some successes, but overall, this is not going so well for the entire global population. So according to the math and statistical people that I've heard talk about this on the log scale charts, you should see the curve start to flatten out when it stops going parabolic and the hockey stick stops. So for a certain period of time, it looks like towards the mid to late February and early March, it was starting to flatten out. But now there's a lot of reinfections. We're hearing a lot of anecdotal stories, and the news media is even covering these in Singapore, in South Korea, and in mainland China. There's a lot of them. So unfortunately, countries like Singapore, which were doing a good job, it looks like for a couple weeks they got somewhat complacent, and now there's a lot of reinfections occurring in countries like Singapore, South Korea, and China. So that would explain why the curve is not flattening out. So in certain specific countries or certain specific states here in the United States, the curve may be flattening out, but globally, as you can tell, this is not the case with both the linear charts and the logarithmic ones. This is another hockey stick. This is probably even crazier than a hockey stick. This is the amount of jobless claims here in the United States in just the last 4 weeks. 22 million adult Americans jobless claims, and the stock market is still rallying, mostly because of the Federal Reserve just flooding the amount of liquidity and bailout programs, all different types. All that's really left at this point, in my opinion, is rules changes and bailout programs until the economy gets back to normal. And I'll explain that in the conclusion. So this is from Jim Bianco, Bianco Research. This is total continuing unemployment claims. So it's gone parabolic, or as some people, it's even worse than that. This is just going straight up. So it's not even a hockey stick. It's even crazier than that. But this is to put things in perspective of the real economy, the pain that Americans are feeling with lines for food banks and so many other problems. There's a real cash flow problem in the economy. So all of this is related. Total infected cases. The Fed has to step in and help the global economy with the dollar shortage. Fed has to step in and provide liquidity for not just the US economy, but the entire system because of how much dollar denominated debt and how much forward dollar swaps, those dollar liabilities, when you add them up, as you heard me explain on the George Gammon interview. Also, people who have been around my channel for a long time know that I've been talking about this for months. So there's all these different hockey sticks in the real economy. Another one that people are not talking about yet, George Gammon was. Thankfully, we do not have a lot of velocity of money yet. Otherwise, we'd start to be talking about really, really bad stagflation, or worse, maybe hyperinflation, is the amount of M2 money supply growth. So the M2 money supply is going insanely high. Year over year growth rate record 14.57%. Shout out to Peter Schiff's son, Spencer Schiff, who is posting these updates on his Twitter. He actually has a big Twitter following. I think he's only 17 or 18 years old. So he's crushing it with these tweets out there. Chip off the old block. But the M2 money stock is growing very, very rapidly. This shows that the Fed is doing enormous amounts of emergency liquidity injections. But again, because velocity of money, it was low before the coronavirus, before the global pandemic started, but it's collapsed even lower than that. So this is why you don't have all of that really, really crazy inflation that a lot of people in the gold community are talking about, because the lending and spending in the real economy is not occurring anywhere near the pre-coronavirus levels yet. We may eventually get there, and the Fed is going to have a challenge trying to take all this currency and credit out of the system. Otherwise, it could be like Venezuela hyperinflation, or Zimbabwe hyperinflation, Argentina hyperinflation, or the Weimar Republic hyperinflation. With that amount of money supply and credit in the economy and velocity of money, which easier to explain for velocity of money. Art Cashin, legendary Wall Street trader, calls it just lending and spending or money turnover in the real economy. And obviously that's not occurring right now because consumers are not going out to restaurants, bars, and doing as much shopping at malls, doing the normal things that Americans used to do prior to the coronavirus. All of that economic activity, you can measure that with gasoline demand, consumer behavior. All of that's down at least 35-40% already, and it's probably going to get worse. Gasoline demand's already down 48% year over year. Finally, these are the central bank balance sheets, and the central bank balance sheets are also starting to get ridiculously crazy. So the central banks are going to have hockey sticks. This is the European Central Bank balance sheet, but it has not been updated since February 2020, which is basically before the European Central Bank did another 750 billion euro intervention program. And I put up there in red what the ECB has to buy now from my sources, including a upper management at one of the credit ratings agencies, that a lot of leveraged loans, collateralized loan obligations, and bad European corporate and European government bonds were hidden, especially the leveraged loans and the CLOs were stuck. The European banks were stuck with these when the game of musical chairs ended in the last 5 or 6 weeks. So the European Central Bank and maybe even the Federal Reserve will have to help out the European banks with that. So the central bank balance sheets will be covering for all the other hockey sticks that I've shown in this short little video. This is the Federal Reserve Bank balance sheet. It is now up to 6.37 trillion. Just in the last 8 or 9 weeks, the Federal Reserve Bank balance sheet is up over $2 trillion and climbing. Its pace is over $200 billion per week. I had hedge fund manager Tavi Costa on for an interview. I'm having real bad problems with YouTube now uploading that. I don't know why. I've never had a problem in years uploading videos like that before. It is an amazing interview with hedge fund manager Tavi Costa of Crescott Capital. And he says that the Federal Reserve is now creating $75 billion per day. So the Federal Reserve balance sheet is another hockey stick, as you can see there. The Fed's official balance sheet and the shenanigans are even worse off balance sheet, according to Fed insider Danielle DiMartino Booth, who used to work at the Dallas Fed for 9 years. But the Fed's official balance sheet is now over 20% of the U.S. GDP, and it is climbing very, very rapidly because the Fed has to plug all these different holes, not only in the U.S. economy, not only with U.S. government budget deficits, not only with Americans who didn't save any money and need payments to buy food, but also the problems in the global economy with the dollar shortage. So finally, this takes us to our conclusion. I've showed a lot of hockey stick graphs, and I think they're all related. So it has to do with all the global cases, total infected, total deaths, jobless claims, because the coronavirus is the monkey wrench that sabotaged the global supply chain. It's really thrown an enormous monkey wrench into the gears. And then you have all the problems with the global economy not functioning properly. So the global pandemic has collapsed the normal levels of cash flows that all levels of society depend on for their incomes, debt service, or paying off smaller amounts of debt and tax revenues to all levels of governments. Central banks are attempting, keyword attempting, which means they're not always going to be successful every single day, Monday through Friday, manipulating stock prices higher, to paper over and reflate collapsing toxic assets that have now turned into liabilities with bailouts and rules changes. And that's, in my opinion, all that's left until the pre-coronavirus economic activity levels return, as well as cover the enormous funding gap governments now have with tax revenues collapsing. Central bank balance sheets and the off-balance sheet stuff is even worse than the stuff that we see on balance sheet for the European Central Bank, the People's Bank of China, the Bank of Japan, and of course the Federal Reserve are now hockey stick charts because of welfare social program payments, which is only scraps to Main Street versus the amount of corporate welfare bailouts and other largesse, including that $500 billion slush fund that both political parties here in the U.S. agreed to for large corporations, compared to Wall Street and large corporations, and the evaporation of pre-coronavirus tax revenues. Central banks are attempting to fill the rapidly widening gap. The dollar shortage outside the United States compounds the difficulty of the Fed's new bailout policies because now the Fed can't just worry about the U.S. economy. The Fed realizes now with this global repo facility, with the 2 currency swap press releases in only a week, they realize how badly broken the entire global economic system was over the last 5 or 6 weeks. The credit markets totally froze up. An enormous amount of corporate bonds, whether investment grade, which they won't be for much longer, or junk bonds, leveraged loans, CLOs, all went no bid. The Fed was bailing out hedge funds. Tons of the large hedge funds, including Ray Dalio's hedge fund. Christopher Cole and others have talked about this. I did another show on this in the last couple weeks. The risk parity trade, which Ray Dalio invented, and also the basis trade, enormous over-leveraged, unhedged hedge funds blew up. This started with Repo Madness back in September. I believe some hedge funds were crippled, if not went bankrupt then and were bailed out or kept alive as zombies back in the initial Repo Madness, and they lied to us and they claimed it calmed down. It really did not come down, and the knockout blow for these hedge funds came in the last 4 to 6 weeks with the global pandemic and the coronavirus just absolutely screwing up all of their leveraged bond trades and other trades on leverage, where they had used the repo market to borrow and then leveraged up, and they couldn't pay back those loans because their trades went bad. And unfortunately, money markets had loaned enormous amounts of money, because I know this because some of my podcast listeners sent me screenshots from their money market funds that went into the repo market. Their money market funds lent into the repo market. Some of these money market funds lent 30, 40, 50% of their funds into the repo market, and then the hedge funds that borrowed could not pay it back. Then you also had investment banks that were on the hook to buy, primary dealers that were on the hook to buy enormous amounts of U.S. treasuries. So it was all a mess. And repo was, as George Gammon correctly states, one of the key indicators, just like how in China, Baoshan Bank and the other banks that failed was another canary in the coal mine warning signal. When the U.S., the repo market in September was the main warning signal. And finally, we get to the race to debase accelerating. Central banks will try to plug the holes, but rapidly devaluing currencies all over the world are guaranteed until normal economic activity resumes to reduce the burden on central banks. This is all about a cash flow. This is a cash flow problem. You cannot service debt. You cannot pay back debt without cash flow. And so the cash flows that the global economy normally relies on have almost all dried up. That is the main problem here, a cash flow problem. There's also collateral problems. There's assets turning into liabilities similar to 2008. But again, the society runs on cash flow projections, people plugging in numbers to Microsoft Excel spreadsheets. And then when those projections do not hit because of the debt levels in society, that's when the problems occur. Finally, do you have gold or silver? And gold or silver is not an investment, in my opinion. It is just for insurance, wealth preservation, and savings, because you cannot save long-term in digital debt-based fiat currencies where all the governments and central banks intentionally want to devalue them. Okay, so that's it for this short little video. I want to thank everyone for listening. Again, lots of hockey sticks now. I do not see this changing until the cash flow problem in the global economy, until we resume somewhat normal levels of economic activity. Until that happens, the central bank balance sheets are going to keep expanding. And that should mean that currencies are going to be intentionally devalued. The acceleration of currencies devaluing is going to keep occurring.